Hi guys, I'm Phil Town for Rule One Investing, and today I want to talk to you about stock shopping in an overpriced market. Hey, as you guys may all know, and may have been seeing lately, this market is way up there, really up there. I think it's quite overpriced. To put it like simply, we're looking at a market that's priced at about 2 or 3% yield on earnings, which is crazy. And we might be on the verge, because of that, of a major market correction. Now, I don't know, right? Because the Fed's pouring money into this thing. But, we don't know. Rule One investors, we just got to go out and do what we do, which is still finding valuable companies at great prices. I went live on Facebook not very long ago covering this topic, and I think it's really, really important. So today, I'm going to share some of the highlights of that live Facebook video with you guys here. So let's roll the clip. What I'm going to do first off is let's just say I'm looking at a pile of stocks, in a book of stocks, all right? Open up the page and there's a description of the company. The first thing I need to understand is whether this thing is something simple enough that I can get my head around it. Now, after 40 years of doing this, I've got an idea about what I can do and what I can't do from making mistakes in this regard. But this is the first thing I want to get a sense of. Is this a company that I can get my head around? All right. And if it is, so for example, I can get my head around Harley Davidson, or I can get my head around Thor. They make a lot of RVs and stuff, or Winnebago. I get my head around a grocery store like a Kroger's. So those aren't hard. A fast food place, I can do that. When it comes to figuring out something like Applied Materials, which is one of the guys that works with me, is so much smarter than I am and has this huge, deep history of working with computer type companies, and feels extremely comfortable dealing in this world of AMAT, where they have a tool that makes chips, or I guess. And man, I'll tell you what, it was really hard for me to try to get my head around, and it ended up passing on a company that he had nailed it perfectly on buying that at the right time. But I just couldn't get my head around it. And this is where I make hopefully all my mistakes, and I hope this is where you make your mistakes too, is you're not buying something that on hindsight, with 2020 hindsight, you'd be, oh, I should have done it, right? And typically the reason that I'm not going to pull the trigger is because of this first thing. It's just not a simple enough business. And that requires discipline, because it's really easy to just slide over into something that you feel like you could understand. So I'm going to take that pretty rigidly. And then I want to know, is it predictable? And what I'm going to determine its predictability with, just on this real quick survey where I'm just glancing at a page for a minute, is first off, what's this company do? Okay, yeah, I can handle this. All right, next, is it predictable? And the first thing I'm going to look at is, what's the revenue look like? If they can't get predictable revenue, the rest of the numbers are going to be a train wreck, right? Cash flow, earnings, those things can get really easily manipulated, very hard to be really consistent. So let's go look at revenue, where that's the easiest one for these guys to get consistent. And the reason it's easy for them to be consistent there is because that's typically how they're going to get paid. How big's the company? If you want to drive a G3 jet, if you're a CEO, you need a big revenue company. So everybody's got their attention on that. And we're not going to buy it based on anything of it, but it's the first quick, easy look at predictability. And I'm not looking for making $10 a share of revenue every year, or $1 million of revenue every year. I'm looking for predictability of growth. I want to see that this company is not just dead in the water and struggling. I don't want that kind of predictability. And believe me, there's plenty of companies right now that are out there that are exactly that sort of a company. They just can't get any traction. They've gotten to a certain point, they went public, and that's it. Every time they try to move, knocks them back. So we don't want that. What we want is a company where they're definitely growing their revenue. All right, as soon as I got that number and it's predictable, that is, it's growing consistently over time. And I don't really care if it's growing from 10 million to 20 million in 9 years or something. It's 8% growth rate. Well, I care, but it's predictable. That's what I want. Or if it's growing from 10 million to $100 million in 10 years, right? That's gigantic growth. That's looking at 10 to 20, 20 to 40, 40 to 80, 3.5 times. That's a 26% per year growth rate. That would give me pause just because, oh my God, I think they can't keep that up, right? But I'm looking for that predictability. Okay, that's the next thing. Then I want to see immediately, is this the kind of company I would own? And the kind of company I would own, the number one number I want to look for is return on invested capital. So how are they doing getting me a good return on the money that they've got that's mine and the money they've got that they borrowed? That's going to be the return on invested capital. Those two numbers, the equity plus debt divided into the earnings, is going to give you return on invested capital. And that's what I want to see. And I want to see it a good number. All right. In fact, my ideal thing, and often these two numbers are presented right together, is I'll look at return on invested capital and return on equity at the same time. It'll be the next line down or the first line up or whatever. And you're going to see those two. My Nirvana company those are big 20%ers, and they're both the same. If they're both the same immediately, I don't even have to look. There's no debt. There's no debt, right? Because obviously return on equity is just earnings divided by the equity, whereas return on invested capital is earnings divided by the equity plus the debt. So if there's no debt, those two numbers are identical. They're the same thing. So very quickly I can see no debt. Oh, great. This is super good. It's a big number and it's super good. By the way, what's a really big number for return on invested capital, return on equity when there's no debt? A really big number could be 40%. I mean, there are companies out there that do that, okay? They crank 40% a year. Now, they're not typically holding on to the gigantic earnings that they're making on the equity of business. They're going to hand it back in dividends, or they're going to buy back their stock or something. But that's what I'd love to see. And 20%, that's freaking great. I'll even look at anything that's got double digits. It's 10%, great. What I don't want to see is that the ROIC drops into single digits. Nope. And that page gets flipped, and it's just that fast. It's like, no. I'm speaking metaphorically, but obviously I used paper for much of my career. So I was like, okay, I'm kind of use that metaphor. So then the next thing is I'm looking literally at debt. There's usually a number that says what the total debt of the company is. And I would like to see that very close to zero or zero. Makes my job so much easier. If it's a number, I've got to go, it's not zero, right? I got to go to their current earnings, and I try to see that and divide it into that number. I'd like to see it 2 years or less. In other words, if you've got $100 million of earnings this year and you've got $200 million in debt, that's going to pass my test, okay? They can get rid of that pretty quick, especially if it passes the next test, which is owner earnings of the company. Also, you can use free cash flow if the owner earnings numbers are a little harder to generate because nobody presents them. You have to just do them in your head. But you could use free cash flow for this. So owner earnings is basically going to take operating cash, which is definitely, they give you that one, operating cash. And then I am going to add to that just a rough estimate of taxes, because often they'll just show, okay, our tax rate is 15% or 20% or whatever. But if you can see the tax number that they're actually charging, I'm going to add that back into operating cash. So I'm going to get op cash plus tax, and then I'm going to subtract, and this is the tricky number, the maintenance capital expenditures. And if I just can't get at that number somehow, I don't know the business well enough or the industry well enough, then I'm going to just probably use 70% of their capital expenditures as maintenance, right? So if I don't know the business, it's going to be probably 70% of CapEx. That's going to be my maintenance CapEx. I'm going to subtract that from op cash plus tax. So let's say that operating cash is 10 million, tax is 1 million. Okay. Now you got 11 million, and then maintenance CapEx is 2 million. So I'm taking that off of there, and I've got 9 million of owner earnings. All right. 9 million of owner earnings. And I'm going to take a real quick look right here at that number that I'm going to generate very quickly in my head, looking at the numbers, and I'm going to go price compared to owner earnings, because I'm looking for something I can buy right now. Now, oftentimes I will make a note that this company is fantastic, but it's not on sale in any way, shape, or form, but it's something I like to own. I like put a note into my database and just say, I'd like to own this company someday. Like, okay, Sherwin-Williams, right? I would like to own Sherwin-Williams or Clorox. I would, in my dreams, I would like to own Clorox, knowing I'll probably never get to own Clorox because everybody wants to own Clorox and it never goes on sale. So, and nothing ever happens to it. It's just like, you know, printing money if you own Clorox at the right price. So the point is, at this point, I'm going to look at the price against the price I want to pay. And if these things are way out of line, then that's it. That's it for me. I'm looking through the haystack for a piece of gold I can take home. Now, I'd love to hear from you guys. Are you finding any valuable discounted companies in this overpriced market? Please send them in. I need more things to buy. Leave a comment below with your answer and I'll be sure to follow up with you. And thanks for watching, you guys. Now go play. Hey, if you enjoyed this video and you feel it was valuable in teaching you more about stock shopping in an overpriced market, just hit the like button and please share the video with your friends. And by the way, if you want more investing content, subscribe to my channel. It's awesome. And don't forget to click the button on the screen for a free gift. So thanks again for watching.